what I'll do is I'm going to turn over to Walter. He is our Chief Investment Officer, and he'll share with you what we anticipate to be the next asset coming into our fund. This is a beautiful deal, as is all the deals that we bring in. But I'll just turn it over to you, Walter. You want to share this asset class, 107 doors?
Yeah, fantastic. I appreciate you turning it over to me, Dave. Yeah, this week it was actually kind of a challenging week. Analyzed a lot of quality properties, and it was hard to pick one, but I had this particular deal that basically ticked all of our buy boxes, so it kind of rose to the top. As you mentioned, 107 units. The property is situated on the shores of a very popular lake in a prime residential location that sits just to the west side of Orlando. Very easy access to downtown Orlando, as well as very close to Disney and Universal Studios, which are obviously big draws up in that market. Gives you easy access to Route 4. Route 4 is an interesting corridor. Route 4 joins the east and the west side of the state, with Orlando being pretty much in the middle. From the property itself, it is about an hour drive if you want to head east and go to the Atlantic and visit Daytona Beach. You could do that. Or you could go about an hour and 15 minutes and you will be in the St. Pete Clearwater area if you go the other direction. So phenomenal location for the property. The property itself was originally completed back in 1999. So it definitely fits in our buy box there. As you know, Dave, we concentrate on assets 1996 or newer because those properties are going to meet that Miami-Dade code that's so important to us down here. Now, the property consists of 107 units, and it's located throughout 12 buildings in a very park-like setting is the best way to describe it. Another benefit of looking at some of the properties that are, a decade or more older is they have that established landscaping and hardscaping. So, we have that lush background, swaying palms, very nice hardscaping with this property. The property features walking trails, kayak and SUP being a stand-up paddleboard, access to the lake. And then it has 500 feet of actual lake frontage that is reserved strictly for the tenants of this property. So, they have access to that. They also have access to a very high-end 1,200 square foot fitness center that was recently upgraded, as well as a luxury pool and sundeck, which, come on, we're in Florida, that's a necessity. The property is in a gated community, so it has that access to the privacy as well as a very high level of security. Now, the property features a mix of units. They're relatively large units, going from 1,100 feet up to 1,350 square feet. And the mix is pretty simple. We have 62 bedroom, 2-bath units, and we have 47 3-bedroom, 2.5-bath units. Now, the larger unit size is in high demand in this area, and it is a major draw to families that are looking for a more casual lifestyle and access to apartments. So high demand for that type of property. Now, the current owner acquired the property back in 2000. He did do a major reno on it in 2010, including all new cabinetry, tile flooring, new fixtures, and new appliances through the property. However, at this point, the property, from his standpoint, he's taking advantage of the depreciation, and he's now looking to liquidate it and move on to other investments. So that creates an opportunity for us. Repositioning strategy, Dave, on this one's going to be pretty straightforward. We're going to acquire the property for $16.4 million. Our research indicates that the units are lacking in certain amenities common to other amenities in the area. So right now, when we analyze these, one of the big factors we look at is what's the rent per square foot. And right now we're at $1.21 per square foot. Other comparable units in the area are drawing a little bit higher rental rate. So we did a lot of analysis, and what we did is we determined that we are deficient in a few areas. And those are all deficiencies that we're going to cure very quickly. We're going to come in, we're going to invest about another $471,000 into the property. Very light improvements, but they're going to be improvements that make a big difference to people. We're coming in, we're replacing the countertops, putting in nice quartz countertops in the kitchens and the baths, very nice backsplash in the kitchen as well. Stainless steel appliance package to give it that high-end feel, microwave with an integrated vent hood, and we're also upgrading the lighting fixtures and the plumbing fixtures in the kitchens and the baths. Now, how we're going to do this is we're actually going to stage these improvements to work in conjunction with the normal lease turnover. So this isn't going to negatively impact our cash flow. As the leases turn over, we'll come in and we will do these renovations very quickly on a unit-by-unit basis. So within the first year, we'll turn over all 107 units and they'll all be upgraded. Now, as I said, the current rental rate is about $1.21 per square foot. Our market research indicates that upon completion of these improvements, we're going to jump up to that next level and easily will garner $1.41 per square foot. And that's going to boil down to yielding an additional $342,522 in annual rental income. And that goes right to the bottom line. So as we increase our net operating income, we're obviously pushing up the value of the property. So it's really a win-win for our investors because they're going to be seeing a potential increase in quarterly distributions as well as that long-term gain in appreciation on this particular property. And because of the size of the units, the location, the quality of the property, and the planned improvements, our market studies indicate that we should very rapidly be absorbed into the market at the higher rate. So let's talk about the numbers. It's what everybody's here for. Targeted returns on this one. Targeted cash on cash return year one going in almost 14%, 13.95%. That's gradually increasing over a 5-year period. Targeted return, cash on cash return year 5, 16.86%. IRR on this thing's phenomenal, just a smidge below 30% at 29.91%. That works out to an equity multiple of 2.52. What do you think?
Boom.
There we go. I agree with you.
That's what I think. I got a question for you, Walter, and I think it's probably going to resonate in the minds of some of the folks that are listening. We don't use these higher end packages in all of our assets. You've obviously, like I know you've done the due diligence to look at comparable rental units with the 2 beds and the extra bathrooms. I mean, that's the real value component for this asset, and that's what's going to raise us to the market value of the, what did you say, 1.41 a square foot, correct?
Correct. This, just to give you a feel for this property is actually nestled amongst several other developments, single-family home developments that are very high-end developments. So it's a top-end neighborhood. People expect to walk in and see solid countertops, whether it's granite or quartz. They expect to see that stainless steel package. And although this property was upgraded in 2010 and appliances were replaced, he just didn't take it up to the level he should have. Got it. So, a little mismanagement there. That's okay. We're getting it at a great price. We'll be able to add those improvements for a reasonable amount of money, and we'll be able to enjoy the upgraded returns as well.
And I know we were talking before we started on the webinar. There's no competition for this asset, correct? I mean, it's off market. You said correct. Your exact term.
Very much so. Very much so. So we're not competing with everybody that's out there, and we've been able to come to a very fair price.
Awesome. So if you're listening to us right now, and these are the kinds of assets you want to be a part owner in, then we'll talk at the end of the discussion here.